Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, August 30th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It's another beautiful day here in Colorado. We got mostly sunny skies. Got a few cumulus clouds. If you look west towards the range, if you look east, there's nothing. So it is a beautiful day. Apologize for being a little late today. I had to run into town and get some fuel for the truck because we're taking a little adventure over the weekend, little short vacation. And so I had to go load up my auxiliary tank with tons of diesel. So I think I spent about $200 in fuel, which not fun. Anyways, so if it's your first time watching Liberty Call, I'm glad you were here. Thank you very much. And if you could, give me some thumbs up, likes, shares, subscribes, follows, hit the notification bell so you know when I go live. And actually, let me stop what I was doing here. Let me share my screen again because I forgot to add sound. Oh, there we go. All right, because we're going to listen to a recording in a little bit. Oops, let me take that off the screen. We're going to listen to a recording from one of my favorite podcasts, and going to talk about where things are kind of headed from rates, and where we can kind of expect the economy and the markets to head. So that's a little extra special for you at the end of the at the end of the broadcast. So, but let's first get into the numbers for today. The Dow Jones was up 0.11%. It was in the red shortly before the close, but finished up 37 points, closed at 34,890. S&P 500 was up 0.38%, closed at 45.14. NASDAQ was up 0.54%, closed at 14,019. The VIX fell 3.94% today. It's down to 1388. Canada was up 0.2, Brazil down 0.73, and Mexico up 0.24. Over in Europe, Germany was down 0.24%. The UK was up 0.12%. France was down 0.12%. Netherlands flat at down 0.06%. Spain down 0.31%. Italy up 0.09%. Switzerland down 0.14%. And Portugal down 0.24%. Russian exchanges were split today. The MOEX fairly flat, up 0.04%. RTSI down 0.75%. And the overnights, the Nikkei in Japan was up 0.38%, Australia up 1.21%, New Zealand up 0.2%. In China, the Shanghai was up 0.04%, fairly flat. The Shenzhen Component up 0.26%, China A50 down 0.39%, DJ Shanghai down 0.07%, Hang Seng up 0.07%, and the Taiwan weighted up 0.69% for the day. All righty. So looks like things are a little rockier. Looks like in the European markets. Having a brain fart today. But all in all, not terrible. All righty. Well, let's go ahead and hop into the market recap. Dow clinches fourth day of gains as softer data ease Fed fears. I mean, y'all can wish this into existence all you want, but I don't think the Fed's going to be very cooperative. But what do I know? All right, the Dow Jones extended its winning streak on Wednesday, securing a fourth consecutive day of gains, driven by growing anticipation of a forthcoming Federal Reserve decision to pause its policies. The optimism about a potential Fed pause was boosted by indications of a weakening U.S. economy. Jade, could you sit down and quit shaking? Where was I? The labor market, a crucial factor in the Fed's decision, exhibited signs of sluggishness as data revealed that the economy generated fewer jobs than anticipated in August. ADP, a prominent human resources company, reported that approximately 177,000 new jobs were added in the private sector during August. The figure was significantly lower than the impressive 371,000 increase registered in July. This weaker growth allayed concerns about an overheating labor market driving up wages and inflation. Neela Richardson, chief economist at ADP, pointed out that the nation, well, actually, it's a country. Nation would mean that we are one. We are not one. We are 50 states. So anyways, my soapbox. That the country was moving towards a more sustainable phase of growth in pay and employment after a period of extraordinary gains associated with pandemic recovery. I don't know if I'd call that extraordinary. Accompanying the signs of a faltering labor market, the latest data on second quarter economic expansion showed a downward revision to 2.1% from the earlier estimate of 2.4%. These indicators, combined with the prevailing sentiment, led to almost 90% of predictions for the Fed's September actions leaning towards a pause, according to Investing.com's Fed Rate Monitor tool. In the tech sector, Apple Inc. spearheaded the gains with a nearly 2% rise. The boost was fueled by Citigroup's reaffirmation of its buy rating on the stock, driven by optimism surrounding the upcoming launch of the iPhone 15 on September 12th. Expectations of a price hike of $100 to $200 for the iPhone 15, coupled with predictions of heightened consumer interest among those owning the iPhone 12, contributed to this positive outlook. Tech stocks were further lifted by NVIDIA's 1% ascent, underscoring the strength of the broader sector. However, Ambarella Inc., a semiconductor manufacturer, faced a sharp decline of 20% due to disappointing Q3 guidance that outweighed better than anticipated Q2 results. Ambarella's prospects were dimmed by concerns that its investments in the AI-related large learning models might not yield substantial revenue until at least 2025. Elsewhere, HP Inc. suffered a nearly 7% drop in its stock price after revising down its annual profit and free cash flow projections. The company's second quarter sales also fell short of expectations due to slower than anticipated recovery in PC demand in China. Similarly, Box Inc. saw its stock tumble by 12% due to both weaker than expected second quarter results and annual revenue guidance that failed to meet analyst estimates. UBS noted that unexpected weakness in China had adversely impacted HP's demand, which lagged behind other markets in the APAC region. In summary, the Dow Jones closed higher for the fourth consecutive day amid signs of decelerating U.S. economy, weaker job creation, and revised economic growth figures fueled speculation of an impending Federal Reserve pause. I wouldn't get so I wouldn't think that's going to occur too quickly, folks, but you're welcome to have wishful thinking. Tech sector gains were driven by positive sentiments around Apple's iPhone's 15 launch, while varied performances within the semiconductor industry underscored the sector's complexities. The challenge faced by HP and Box highlighted the global market's intricacies and the potential impact of regional dynamics on companies' performance. Pretty good stuff there, don't you think? I think so. All right, let's dive a little deeper. U.S. private payrolls growth slows sharply in August. All righty. In August, U.S. private payrolls saw a more modest increase than anticipated, underscoring a labor market that appears to be losing momentum while retaining its tightness. According to the ADP National Employment Report released on Wednesday, private payrolls expanded by 177,000 jobs last month. However, this figure fell short of economists' projections, as a Reuters poll had predicted a more robust increase of about 195,000 private jobs. July's data provided a silver lining, as it was revised upwards to indicate an addition of 371,000 jobs, surpassing the initially reported 324,000. The labor market's deceleration comes as it grapples with the effects of 525 basis points worth of interest rate hikes by the Federal Reserve since March of last year. A government report on Tuesday disclosed that in July there were 1.51 job openings available for every unemployed individual, marking the lowest ratio since September of 21. This figure dipped slightly from June's 1.54 jobs. In a related trend, consumer sentiment concerning the labor market showed a less optimistic outlook in August, according to the Conference Board survey. The ADP report, a collaboration with the Stanford Digital Economy Lab, was unveiled prior to more comprehensive and highly anticipated employment report for August, scheduled for release by the Labor Department on Friday. However, the ADP report has not proven consistently accurate in predicting private payroll numbers in the official employment report. Economists surveyed by Reuters are predicting that the Bureau of Labor Statistics will announce a rise of 150,000 private payrolls for August. When including government employment, the projection for total non-farm payrolls indicates an increase of 170,000 jobs in August, following a gain of 187,000 in July. So it seems like things are kind of slowing down, and that's something that I've been telling folks, basically all year, is that while the expectation is for a slowdown, especially with the yield curve being inverted, that we're probably headed towards something bad. What it's going to be, I don't know. Some sort of black swan event will occur, and markets, the economy, everything's just going to go into the crapper. But granted, it may be short-lived, maybe long-lived. Who knows? but we shall see. All right. Last up is like I said, it's a podcast. It's called, the podcast is Liberty Lockdown, hosted by Clint Russell. His guest today on yesterday's episode was Tom Luongo, someone that I listen to. I read his newsletters, someone I have a ton of respect for. It's titled, Could the Federal Reserve Be on Our Side? Like meaning the people as opposed to big business. So we're going to go ahead and listen to a couple minutes of this. And he's going to be talking about, what the different central banks, what their options are right now, and moving forward, what he thinks is going to happen. So let's go ahead and press play.
That ended. Powell's been raising rates. They got off the board. The SNB, the Swiss National Bank, they're off the board. The Bank of Japan just got off the board. They just got off the train because they're ending yield curve control or tweaking it. What that means is that they're going to allow rates to rise to try and keep capital from outflowing out of Japan. They need to stay ahead of. They're behind on inflation. Inflation in Japan is running 3.5%. Again, manipulated CPI numbers, but let's just work with the numbers we have. Not that we agree, not whether we agree with them or that we even like them, because I hate them all.
Right.
But the Japanese 10-year still trading at 66 basis points. The 2 years trading at 50 basis points or whatever the hell it is. It's not good. They got to let yields rise. If they do that, that means that the yen is going to fall, right? Well, they have one of two options. They can either let rates rise or they can let the yen continue to fall. Their only choice. So they're off the bandwagon, right? So the ECB is the last one that they've raised rates, but they were the one that has not wanted to raise rates. The Bank of England has raised rates almost gleefully. The Bank of Canada has raised rates almost gleefully, and I have it on good authority that the Canadian banks are backing Powell's play 100%, which is why why the people did not lose their bank accounts over the truckers' revolt. When the Canadian Senate intervened and stopped the Emergencies Act from going through, that order came from TD America, that came from TD Bank North and all those guys.
Wow, interesting.
Flat out, done. Have it on good authority, like directly from those people. Done. They back Powell's play in every way. So who's left of that original seven central banks? The Fed's out, BOJ's out, BOE's out, Bank of Canada's out, SNB's out, ECB. Who's left? ECB.
I don't know.
Nobody. They're all good. They're all fucking out.
Yeah, okay.
So what Lagarde is doing now is literally just trying to, with her, with fingers in the dam, trying to keep doing yield curve control. And the only ally she has left is Janet Yellen over at the Treasury Department. But Janet Yellen has the problem because remember, Davos wants to destroy the United States. How do you destroy the United States? You destroy the United States by getting us to spend in ways that makes drunken sailors ashamed to be drunken sailors. Right. Undermine the fiscal situation, force the Fed back to the zero bound because we can't afford the debt. And Powell's like, no, it's not my problem. Go ahead, raise $1.5 trillion in capital. You're doing it at 6%. But that'll blow out the budget. Exactly. That's exactly what I want to happen. I am over this. We are done. Europe is the one that can't handle this. Europe's banks are fucked. There isn't a real bid under a German Bund at this point. Okay. So they're all out. They're all done. The whole thing is broken apart. They're in the intense negotiations of who's going to lose.
So do you think
I see it as Europe? And once the European bond markets finally explode, all that money is going to flow into the United States. The dollar is already starting to rise. We're going to get that. The U.S. equity markets are going to tread water. The Dow is going to tread water, if not rise. The dollar is going higher. Gold is going higher. Oil is going higher.
Interesting.
The collateral-based money is going to get the ground. When the sovereign debt markets start to go, money will get the ground, and ground means tangible assets, and the closest thing in the debt markets are hard assets, which in this case are U.S. Treasuries. So you'll see U.S. Treasuries rise slowly, but you're going to see European bond yields explode. Okay.
All right, we'll go ahead and stop that there. Definitely some good information. Like I said, Mr. Luongo is a really bright guy. I think he was sort of a computer scientist or something in his previous life. And today he basically evaluates assets and things like that. So real smart guy. They do use a little salty language. So, be prepared if you listen to the whole thing. It's about an hour and 30 minutes. They do use a little bit of cuss words. So, me being a former sailor doesn't bother me in the least, but just giving you some fair warning out there. So, all right. So I would definitely take an hour and a half. I listen to it at like a 1.5 speed so I can, knock out an hour and a half podcast in under an hour, but definitely some good stuff. What he sees is that all the other central banks are basically going to, capitulate, and, the US dollar will be the shining light or the shining beacon of all the other trash out there. And that, once the European Central Bank collapses, all that money is going to come into the US, which for a time is going to help the stock market, the treasury markets, things like that. But we still have the same problems that we had 3, 4, 5 years ago. So yeah, it may give us some temporary relief in the equity markets, the treasuries, things like that. But we still have the same warts that we've had for years. So it might give us some time to reconstruct our battle plans or make some adjustments. But I think things are going to get, like I said, they're going to get bumpy. But I think the U.S. will probably be the last of the major banks to finally collapse. But again, is what it is. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.